Good morning and welcome to this Monday, January 25th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Currently, we've got mixed futures as we start a new week. NASDAQ looks really strong this morning. Futures up over 100. I think last time I looked at the Dow was down almost 200. S&P 500 was down slightly. So it appears that we'll get off to a bifurcated start. A little bit of strength on the NASDAQ, not so much elsewhere. Earnings starting to pick up again. We had a lot of the bank earnings out last week. A lot of financials really for the past, 7, 8 trading days. That's going to start to change. We're going to start to get a lot more of the large cap technology names, consumer discretionary names, and so forth. So this is going to be an interesting week just to see not only how these reports come in. I believe the numbers are going to come in very strong, but I think the market's reaction to it's going to give us a little clue as to whether or not this rally continues or whether it's time to pause for a period of time. Bull markets generally go higher, but you do go through periods where you see a little selling and some consolidation. And I think the reaction to the earnings reports excuse me. I think the reaction to the earnings reports is really going to be the key as we go through probably the next couple weeks. All right. Let me first take you over to Earnings Beat, especially for those of you who are new. Just want to point out a couple things over here. First of all, if you are new, we'd love to have you join our community. We've got a free newsletter. There's no credit card required. You can unsubscribe at any time. I always say you're not going to hurt my feelings if you unsubscribe. We try to teach the things that, we believe are important to our community members. And if you go in, you check out the Earnings Beats Digest, you like what we have to offer, then I would suggest you take out a free trial to our service. It's a $7 trial, but then we refund you the $7. So you can come in for 30 days and check everything out. And I'll tell you, today would be a great day to join because later today, we're having one of our more popular webinars of the quarter, which is our Q4 earnings webinar. And I'm going to go through and take a look at a lot of upcoming earnings reports that I think you need to be aware of. Companies that I believe are going to report some great results. Doesn't necessarily mean we're going to get positive reactions, but if I see a company that I really like on the chart and they come through with a great report and then they pull back, buy on rumor, sell on news, I think that can present some of the best opportunities in the market. That's what I like to trade. I really get excited about trading around earnings reports because it gives Wall Street another set of facts in terms of trying to value a company. So it's fundamentals, but then we look for the technicals. We look for how the reaction takes place to really try to identify the best area to potentially enter a stock on the long side. I do not consider shorting. For those of you who might be interested in shorting, I have no interest in shorting a bull market. There's just too many stocks going up to try to hand pick out the ones that aren't. Rising tide lifts all boats. I mean, my gosh, the short squeeze chart list, which I've been talking about and writing about a lot over the past few months in this bull market, as some of these companies that are heavily shorted start to show any signs of strength whatsoever, it has been absolutely crazy in these stocks that are heavily shorted. GameStop was up 50% on Friday. It's up in pre-market. Last time I looked, another 50% this morning. This stock was at 20 2 weeks ago. It's trading up near 100 today. Has nothing to do with fundamentals. Has nothing to do with divergences, overbought, oversold. You can throw all that out the window. It has everything to do about folks panicking that own a lot of short shares. I always say it's like being in a movie theater that's on fire and everybody's trying to get out one exit, down in the lower left-hand corner, and they're trampling each other trying to get out. That's what's going on with these short squeezes. We'll talk a little bit more about that later. But anyway, check all this out. Like I said, it'd be a great time to join our service because this is a member-only event this afternoon at 4:30. But your trial's 30 days. That takes you over the February 19th draft day. for our next portfolios. And I want you just to look at the portfolio performance we've had since we started these portfolios. It's absolutely phenomenal. As good as the model portfolio and aggressive portfolio have been, the strong AD portfolio, which is strong accumulation distribution, has been even better. It's up almost 100% since May 19th. And these are 10 equal weighted stocks in each of these portfolios. This is not, high flyers, trying to hit it big with penny stocks, anything like that. These are, solid companies that we've been including in these portfolios. But high growth in a low interest rate environment is driving the market. And if you're in the right ones, if you're in the leaders, you can really do well. So anyway, check all that out. We'd love to have you this afternoon. Join us for that webinar. And at a minimum, sign up for our free newsletter. Comes out Mondays, Wednesdays, and Fridays. I think you'll find some really good information in there. All right, Friday's action, a little mixed. We saw the Dow Jones Industrial Average down 179, S&P down 12, NASDAQ up 12, mid caps were up 9, small caps the big winner of the day, up more than 15 points, up 1.25%. All the major indices trading in great fashion as you look. I mean, I don't see anything negative on here. Some might look and say, well, negative divergence on the Dow. Well, negative divergence is a potential short-term warning sign. But when I see like the NASDAQ turning up and with today's strength, I mean, we may eliminate that negative divergence. A negative divergence doesn't guarantee us anything. It gives us a warning sign. But if that's the only warning sign we see and you're in a secular bull market, I'd stick with the market. Now, if we're starting to see other warning signs, for instance, if we were having huge strength in defensive groups for the last month, that might be something else to consider along with the negative divergence. But the aggressive groups have been leading the market for the most part. So I'm just not seeing warning signs out there. Consumer discretionary just trouncing consumer staples. You've got transports crushing utilities. These are signs of a sustainable bull market. So you don't want to ignore all of that. As far as sectors go, we did see defensive groups pop up on Friday. Real estate and utilities led. Communication services also finished in the positive. These were the only three sectors that actually finished strong or finished above zero on Friday. Financials and industrials, the two worst. They've been struggling a little bit as we've seen the 10-year Treasury yield pull back. I think that's temporary. So I do think you're going to see money rotating back into financials and industrials. Don't know if they're going to be the leaders going forward, but I think they're going to go higher. All right, moving on to the 10-year Treasury yield. Nothing out really today in terms of economic news. So I don't know that there's any of that really driving the 10-year Treasury yield. I mean, I talked a couple weeks ago about that black filled candle right there off of that uptrend. That's a reversing candle. So I'm not at all surprised we've moved back down toward the 20-day. I think we could even go down to 1%, sitting at 1.065 right now. 20 days at 105. So I think we're probably getting closer to a near-term bottom in the 10-year Treasury yield. But if we do break below that 20 and go back to 1%, maybe we see a little bit more weakness in the financials in the near term. And I'll talk about that a little bit more in just a moment. Let's move on. I want to talk first, before I get into the financials, I want to talk a little bit about some of the global markets. Because I'm of the belief that we are going higher across the globe. This isn't a U.S. secular bull market run. I believe that this is a global secular bull market run that is going to last a long time. This is a 5-year chart of the Hong Kong Hang Seng, the $ HSI. That's your ticker symbol. But you can see we've been downtrending for a while. Nice little channel. That's ended here at the end of November. I would say really about the time the vaccine news hit, the positive vaccine news, that's about the time we saw the Hang Seng really start to strengthen. I mean, we were down 27,000. We got up to 29.4 on Friday, and this doesn't include today. Let me tell you where we are today. I had a really strong overnight session on the Hang Seng, and up 711 points to 30,159. So now we're up to here, basically trying to take out a 2-year resistance area. I think we're going to make our way up eventually to 33,000 and above, and eventually clear that 2018 high. And I think it comes definitely in 2021. First quarter might be a stretch because it's already run up quite a bit. But I think after some consolidation, I believe we will break out probably the latter half or the latter part of the first half of the year, or maybe into the second half. But I think we're going to see a breakout in the Hang Seng. How about the Nikkei? Oops, no dollar sign. Do it when I was typing it. All right, so here, another big breakout. Look at this 5-year chart. Look at all the tops here coming across just above 24,000. We've blown it away. 28,631. It was up another 191 points overnight. Very, very strong action there. The Shanghai, I don't talk too much about the Shanghai just because a lot of other folks do. And I honestly don't think that there's a whole lot of correlation between the Shanghai and the U.S. stock market, the S&P 500. And so if the correlation isn't that great and I focus on U.S. stocks, then there's not a whole lot of reason to talk much about it. But it is kind of following these other indices, and it is breaking up, moving above the high from January of 2018. You can see on this latest move up on the weekly chart, when we pulled back, where did we hold? That rising 20-week moving average. That's a really good long-term signal. The last time we saw this big move up, beginning of 2019, you saw the pullback, couldn't hold the 20-day. Actually, we just went sideways for a while. Now we come roaring back, break to a new high, hold the 20, or I think I said 20-day earlier, 20-week EMA, we hold it, and then we break back out to another high. So I think this is looking good. Last one I'll show you is the German DAX. This is the one I tend to watch the closest. And we just broke out beginning of 2021 to an all-time high. So taking out the high that we saw back in February before the pandemic, taking out the highs from late 2017, early 2018 before we got into the trade war. And through all of that, here we are now back up at or near an all-time high. So far this morning, we do have the German DAX down 194 points. So it's down to 13,679. I would watch that rising 20-week moving average. I believe it'll hold. All right, let's move on. So I talked about the financials earlier. I want to show you the financials because this is a group that was leading. Since we got the news, this was the news, the first piece of news from Pfizer about the vaccine. And you can see financials were one of the biggest beneficiaries. Got the big gap up, and we have traded above the 20-day moving average ever since. So we are clearly in an uptrend. There is a negative divergence here, a slight one on the daily chart. So it's possible we go back to the 50-day moving average, but I mean, we're not that far from the 50-day. We're talking about maybe a 3% drop, 3 to 4% drop, which wouldn't be huge. And if the 10-year Treasury yield remains weak, that could be the catalyst to drive financials a little bit lower. But overall, I still think we look pretty strong here on this chart. Now, one of the problems, look at the high right here, and then we pull back and hit the 20-day. This is really kind of how the market works. When you're looking at an hourly chart on the financials, I want you to check out this high in January, pull back to the 20, go to this high. What's the PPO doing? Higher highs in price, lower highs PPO, pull back, hit the 20-day one more time, and move to another high, and once again lower. 3 highs, 3 lower PPOs. That's a negative divergence on the hourly chart, and you can see the selling that has we've seen since then. So these short-term signals can lead to longer-term signals. So the short-term told us there was a negative divergence. Maybe we'd get a pullback. Well, we've gotten a pullback, and now we're down to the 20-hour EM, or excuse me, 20-day EMA. So the 20-hour has been lost, and you can see we're struggling to get back up above it. A good sign would be simply getting back up above that 20-hour, because currently we are above the 20-day right there. So if we start off and have a good day on the financials, then I would suspect that we probably are putting in a short-term bottom. Now, with the 10-year Treasury yield lower, my guess is that that's probably not going to be the case. I would think that we're probably going to see a little bit more weakness in the near term. Maybe we get that 50-day test, maybe just a gap support. You know, we had a big gap up on heavy volume to begin January. It's possible we go down to whatever that open was, which is 29.77. That's a level that I think is certainly worth watching as well. All right, let me pull up another sector. How about the XLC? This is communication services. Now, communication services, do you see how we, on a daily basis, we were moving up, trying to get through, putting in slightly higher highs, and that PPO was lower, and we went down. We got to the 50-day. That's also price support. So let me annotate this. So there's your high. Here's another high. And look at where we went down to, where our low is. I mean, perfect execution of testing price support before turning right back up and setting a new high. So, I mean, communication services, even though it was out of favor for a short period, you don't necessarily want to give up on these areas. I mean, the areas that I would focus on are the aggressive groups. And that's technology, consumer discretionary, communication services, industrials, and financials. My biggest question is not whether those groups lead. I think they're going to lead. My biggest question is which of those groups leads. And especially industrials is the one that's been kind of weak that I just think could be the one that comes back to life. And I wouldn't be surprised, if we get through earnings season and the talk begins to shift towards infrastructure, that we start to see these industrials really begin to make a move. But we do want to see it on the charts. We don't want to just assume that that's going to happen. So looking at a relative strength, looking at the market on a relative strength, I think it's still hard to get away from consumer discretionary and some of the areas within technology. Those are the two keys. And now communication services moving back and breaking out to the upside. Internet stocks really had a strong week last week. All right, one more. I mentioned consumer discretionary. Let's take a look at that. Now, consumer discretionary never went back to the 50. I mean, you can see like a slight negative divergence on that high in mid-December. We pulled back intraday. We got close to the 50, didn't quite get there, but we were not far from the center line test. I mean, once you're at the center line or close to the center line, there's not a whole lot of momentum in the market. So even if you're seeing a negative divergence, I mean, what are we looking for? Another 1% of action to the downside? I mean, at that point, you're probably splitting hairs. If you're in a bull market and you're close to the 50-day and you're in a good group, probably not a bad idea to be thinking about getting involved on the long side. And you can see now, look at the XLY moving higher. Now look at the daily PPO, which is broken to new highs. So now we've got a really strong momentum move to the upside in the XLY. Any test of the 20-day moving average would be a great entry point. So I would certainly, and I'm talking about, top level sector ETF standpoint. I mean, there's always individual stocks within the groups that are doing their own tests of key support areas that are probably great buys. You don't have to wait for the entire sector to move down to a support level to be looking within the sector. And I'll kind of show you what I mean here. So let's pull up the sector summary. And for those of you maybe who are not familiar how to get there, if you're new to stock charts, go into your dashboard, when you're signed in, and this on the left side under member tools, just scroll down under summary pages. And then you hit sector summary, and here you are. Now, you can do a lot with this page. This is just telling us what happened on Friday. Well, we could sort it by scooter to find out what area is ranked highest by the stock charts technical ranking system, which is a scooter score, SCTR, stock charts technical rank. This was developed by John Murphy. I would say the biggest limitation of the scooter is that it really only looks back about 5-6 months. So if you're somebody looking at a long-term weekly chart, 5-year chart, I don't know that the scooter is going to, give you a lot. I mean, for instance, energy is in the middle here at 43. Well, if you look back over the last 10 years, energy's been horrific. Energy's come to life in the last 3-4 months. And so maybe even less than that. And so that's beginning to drive its scooter score higher. So it looks like it's in the middle of all these different areas. It's not one of the middle groups, not yet. I mean, it's strengthening in the short term. Long term, it's still got a lot of work to do. So that would be the one thing I'd be careful about. But you can sort these in scooter order. You can sort them like they were just sorted in percentage change. This is the worst performers, best performers. You can go back and say, okay, what's best area for the last week? And you can see communication services. And if I want to dig down and say, okay, communication services had a good week, what led in that sector? Click on it, And there's your internet. That's what I was talking about. Internet had a great week, up almost 8% last week. Now, you want to take a look at internet? Pull up the chart. And here's internet. Now, I'm going to probably go over to here to this daily chart, makes it a little bit better. But here's your breakout. I mean, internet's went sideways. This was one of the reasons the communication services wasn't doing a whole lot. Internet moved up and broke out. And so that's created some nice opportunities in a number of the internet stocks. Let's see, next, well, let's go back and let's pull up consumer discretionary and let's sort these by scooter. So automobiles remain very strong. Furnishings, I mean, did you know furnishings had the second highest scooter score? I just looked at it. I didn't know they were second. But let's take a look at that chart and see what's going on. Well, it's just been very consistent, continually moving higher. AD line looks good. Nothing really horrible there. One group that's moved up quite a bit recently has been travel and tourism. You can see last week had a rough week, but travel and tourism has done well. And you even click to find out which individual stocks had the big weeks that were leading that area. Or you can go into the chart and you can see big move up. AD line's really strengthening. It's pulled back. There's your week pull, 1 week pullback. 50-day moving average would probably be pretty solid for the group as we go forward. I think there's a lot of pent-up demand for travel. And I'm not saying airlines would be the group that I would be going after, because I still think travel encompasses more than just flying. There's a lot of things. You can have companies that have bookings, you know, at the Expedias of the world and so forth, you know, where you can book different vacations and then you can drive there. You don't necessarily have to fly. So when I think travel and tourism, I'm not necessarily thinking airlines. I'm thinking about industry groups that could benefit, or individual companies that could benefit from this particular group going higher. Let's see here. I'm going to move on to the chart lists. So what we do, if you're new to earnings beats or you're not really familiar with what we do, we have a number of earnings or of chart lists that we allow our members to download directly from our website. If you're a Stock Charts subscriber, you need to be at least an extra or a pro member, because that gives you the ability to download up to 250 or 300 chart lists. So if we have 10 on our site, which we probably have a little bit more than that right now, you can go in and download all of our work, all of our research directly into your account, and then you can start working off those chart lists. So we do a lot of work for our members. But this is the strong earnings chart list, and you'll see all of these companies have beaten Wall Street estimates as to both revenues and earnings per share in their last quarterly report. They also, for the most part, are going to be strong companies that are trending higher, or they're going to be part of groups that are trending higher, or maybe just starting to strengthen. There's going to be something technically that I like about the company. So when you look at any stock on this list, you know that they beat Wall Street estimates in the last quarter. That's a common denominator of every stock on here. They are also liquid. So when I pull them up, I make sure that they trade at least a couple 100,000 shares a day. That's kind of my threshold. I eyeball it. I don't double check and look at the 200-day or the 50-day moving average and make sure it's over 200. But I look at the chart, and if I see mostly days above 200,000 shares, then I'll consider it liquid. And then finally, it's just, you know, again, looking at the technicals on the chart. I mean, you see this. This is Ameresco, AMRC. This is in heavy construction. Heavy construction's going up. Ameresco is one of the leaders. Relative to the S&P 500, it's doing well. And heavy construction is continually outperforming the S&P 500. So this is one of the strongest stocks and one of the strongest industry groups in the market. And so all the work's been done. There's the first chart. Now, what you can do with these, which I think is really cool, and this is where we get into some of the stock charts features, is you can pull up this in summary format. So when the market opens, I can go in here at literally 9:31 and I can see which stocks are performing well. And I can then go in and see which stocks are not performing well. Some of these, and what I do sometimes is I look to see the big losers early in the day, and then I'll look at the scooters. And for instance, I see Micron. Now, this is Friday's action, but Micron has been a great performer, but it's down 3%. That might be an opportunity to jump in. So I'd want to pull the chart up and take a look. Now, it's still well above its 20-day moving average. I'd really like to get it off of a 20-day test if at all possible. But you could also say this is pretty good price support. I mean, we had 82.5 as a high, pulled back to 77, 76, and then we blasted back through 82.5. Well, we just came back down right to about that level or just below. Maybe we get a reversal right at this level. Or you might say, hey, stock's got higher prices, lower PPO, negative divergence. I'm going to wait a little while. I mean, what you do with this information, completely up to you. I usually will highlight some of the key areas of support on a chart that I feel are really important, usually from a longer term perspective, not so much, today's support. Obviously you can see a stock like this going to take a little while, but it just give you a general sense that if Micron were to fall back below its 50-day moving average and lose this price support area, I think on the chart, things are beginning to change a little bit. And so every one of these chart strong earnings chartless stocks, every one of them have one or two key support levels on them as well. All right, let's move on. Let's go to earnings. And Kimberly-Clark reported this morning, things are going to pick up. Not a whole lot out this morning. In fact, there were a couple of banks, smaller banks. When I say smaller, 1 to 3, 4 billion in market cap. But they're kind of, at the tail end of a lot of the banks that have already reported or been reporting. So I'm not really interested in those. I don't generally trade those types of banks anyway. It's really rare that if I trade a bank, it's probably going to be a bank like JP Morgan that's hitting a major support level. And I really believe that the banks are, outperforming the overall market. And so something like that, but generally I'm going to stay away from the banks. But here's Kimberly-Clark. So we got the big gap down back in October, earnings related, bounced back up to about 142, 143, hit the 50-day, went back down. We've now got pretty good area of support. This is a gap up that we had all the way back in April at about the 130 level, and we have not closed below 130 cents. We're at 132 going into earnings. We reported this morning 169 in earnings per share, $1.69. Market was expecting $1.61. The reaction, up a couple bucks. So we are, at this point at least, holding that 130 level. If we closed below 130 on Kimberly-Clark, especially in this bull market where everything's been going up, lots been going up, I'd be careful. And I'd be careful anyway. I certainly wouldn't chase a gap. I mean, the volume trends have been pretty weak. Part of the problem is consumer staples is just an area of the market that is not really following the rest of the market to the upside. Many of these consumer staple names are struggling. So something to keep in mind. But earnings will be picking up this afternoon and then especially later this week. I think AMD and Starbucks report tomorrow after the bell. I believe both report after the bell, but you double check me on that. I think those were the Tuesday, the big names. And those are a couple of portfolio stocks that we have at Earnings Beats. So those are pretty important to our portfolio performance. All right, let's move on to the three you must see. I've talked so much about these short squeeze stocks. I've got to bring up a few of these in the three you must see. The first one, GameStop. First of all, this stock, I don't even know how this is possible. It has 136% of its float short. Probably not anymore. Not after all this going on. We'll have to wait and see the next. We did just update, by the way, our short squeeze chart list. So if you're a member, you can go in and download the latest. I think it's already on the website. I did it over the weekend. I think it's been updated. If it hasn't, it'll certainly be updated on the website today. So you can go in and download the latest list. But GameStop, 136% of its float is short. I don't even know how that's possible. I don't know how you can borrow more shares than are actually in your float. The float is the number of shares available to trade. You shouldn't, your broker should not allow you to short shares that aren't available. I don't understand even how you can get 136%. It's the only stock I've ever seen with a short percentage of float above 100%. And when a company has shares outstanding, the float is can be readily available to trade. But you have total outstanding shares. You have a lot of insiders that own shares that they can't trade. They're not registered to trade, so you can't trade them. GME's number of short shares is more than the total outstanding, including all the company or all the insiders that can't trade shares, closely held holdings. I don't even know how to explain it. I would love for someone to tell me how you can have a stock that's more than 100% short its float. I don't even understand how that's possible, because technically what should happen is a broker should only be allowing shorts to the number of shares that they hold. And I think it's only held in the street name. And if you're somebody who owns one of those shares of GME, if you're long and you go in and you put an order in, like a limit order to sell, technically they shouldn't even be using those shares to allow others to borrow in short. So, I mean, it's crazy. If I was in GME right now on the long side, which I'm not, unfortunately, I have traded it a couple of times. I'm not in it right now. If I was in it, I'd probably put a limit order in for $150 or something, just so because I don't know if that impacts the way this, the shorts work or not. But that may force more short covering if a lot of folks put their orders in that are holding the stock on the long side. But anyway, this one has just been crazy, off the charts to the upside, but there are others. And I'll show you a couple of others that are maybe just getting started. Bed Bath & Beyond's in one of our portfolios. Look, it's just opened again today. It's up $7 today. Look at the volume picking up. Short sellers, you have to understand that this isn't about valuations. This isn't about what's the PPO doing. This isn't about overbought. This is about millions of folks on the short side that have unlimited risk to the upside that are panicking and are buying at any cost. And they literally are just stampeding the market with buys. That's how these short squeezes work. That's why GME's gone from 20 to 100. Let's pull up the GME, because this morning I couldn't even believe how high GME was. It's up 52% today. It's up another $34. One last one, we'll wrap up here. How about solar power? SPWR, another one, up 5% today, but it's turning higher. It's also in one of our portfolios. I mean, these, fortunately we're benefiting because we have a couple of these that are heavily shorted in our portfolios, but I almost wish, and it's why I'm seriously considering putting together some kind of a portfolio. It may be a trading portfolio. It may not be like the buy and hold 90 days for portfolio, because I don't think that's really the best way to do this. But it might be a way to try to participate in some of these stocks that are going higher. So still kind of thinking that one through in my head right now, trying to come up with the concept and the strategy and when you get in and how long you hold and all of that. But that's something I'm considering. I know we had a couple questions, actually probably more than a couple, that have come into our support recently asking about whether we're going to do something like that. The answer is probably, but I don't have a definitive answer at this point. We have so many other things. We have the list available. So it's just a matter of whether or not, we can allocate the time necessary to do it in a way that we think's right. So anyway, stay tuned for that. But these charts have just been crazy. And again, just updated the short squeeze chart list. There are 66 companies that have short percentage of float above 20%. And there are probably about 10 to 15 of them that are above 50%. And 50% is a huge number. When we start seeing breakouts, you can just kind of hold on for the ride. It's like being in an amusement park. But they are volatile. So you've got to be willing to take the risk. I can't take that risk for you. If you've got a weak stomach, probably just stay away from these altogether. But if you're somebody who really likes to, you like going to Vegas and sitting at the craps table and stuff. I mean, if that's kind of your mentality with the stock market, short squeeze chart list is definitely one that you should be considering. All right, that's it for me. Let me get a quick update on the market and we'll wrap this thing up. Currently, look at the NASDAQ, 170 points higher. S&P's up 11, Dow's down 90. So certainly money rotating toward the S&P, or excuse me, well, S&P versus the Dow, but more toward the NASDAQ than anything today. NASDAQ 100 up 1.35. Look at the VIX up 4% today. One thing you got to be careful about is when the market moves up and the VIX moves up over a period of time. So that's something I'll keep an eye on. That's, if you go back and you read my article in, I think it was in Trading Places blog back at the beginning of September, pull that chart up, because that's where I talked about the rising VIX and the rising market, and called a pretty important top back then. And it was due to the way the VIX was trading. Anyhow, looking over here at this S&P 600, look at the leaders: GME, BBBY, Best Buy, Bed Bath and Beyond. And then look, here's another one on our short squeeze chart list: SKT up 6.5%. DDD just hit the top list. That's on our short squeeze chart list. So bunch of them on there. Just check those out. This is the stock we just talked about on the strong earnings chart list, having another solid day, up 6%. So go over to Earnings Beats and check us out. Love to have you try our service, but at a minimum, sign up for that EB Digest. All right, everybody have a great day. I'll be back tomorrow over at Stock Charts TV for a recorded version. I do those in the evenings because of COVID. They don't have the staffing to do live shows right now for me. But yeah, that show will be tomorrow morning at 9 o'clock. So make sure you check that out. You got to go over to stockcharts.com, go to Stock Charts TV, and then at 9 o'clock, you should be able to tune in. Everybody have a great day, and be back later with members with the daily market report. And don't forget, we've got an event at 4:30 later today. Happy trading, everybody.